Good evening, everybody, and welcome to F8 Audit and Assurance Revision Class number 4, the final one. Now, before I start talking about this final class, I tried to start this class about 5 or 6 minutes ago. We then discovered there seemed to be a problem. So, if you are currently watching this, could you please say hi at this point to reassure me that everything is now working fine? Can you see me, guys? Can you see me? Can you hear me? Yay! Success. Right, let's get on with it then. Our final class. So far in the first 3 sessions, we have practiced the big 3 core areas rather a lot. We have done audit risk and response. We have done internal control questions. And we have done some substantive procedures questions, but we need to do a little bit more on that. Those are the big 3 core areas in the written questions. But there are other areas of importance as well that can affect the long questions, and we have practiced some ethics. We have done a little bit of audit reporting, but we need to do a little bit more. We've not done any questions yet covering corporate governance, internal audit, neither of which was earning many marks on the September sitting, suggesting both of those will have something on this sitting. Now, at the end of class number 3, I reintroduced to you the idea of how corporate governance comes up on this paper. And I told you 2 things that you need to look out for. One is a knowledge question on the roles and benefits of companies having audit committees. And the second is a practical question where a company's corporate governance is described to us and we must pick out the deficiencies in that scenario. So what we're going to do to start the evening, excuse me, is I will tell you about the roles and benefits of audit committees as a little reminder. And then we'll look at a practical question and spotting corporate governance weaknesses. When you say feedback on the mock exam, what exactly would you like to ask? And if the question is, have they been marked yet? The answer is, no, they have not been marked yet, as I have been teaching every single day and most evenings since I got the mocks. Tomorrow is now the earliest day I can start marking them. So if that was the question, will come back soon, but because the tutor has to mark them to give you the best quality feedback, I'm afraid that does slow the process down a bit. Or was it a different question you had to ask? Okay, I will assume that I've already answered it. If you want to ask something else, please feel free. Cool. Get them back to you as soon as I can, okay? Right, audit committees. What does an audit committee do? Well, I suppose it's worth reminding ourselves that an audit committee is a committee of the board of directors which should have at least 3 people on it who should be independent non-executives, one of whom at least should know something about audit. Otherwise, this is a bit of a waste of time, isn't it? Roles of the audit committee. Well, if I was asked this for 1 mark, I would say an audit committee's job is to oversee a company's internal controls, risk management, and financial reporting. Oh, I'm sorry. My apologies. Always forget to hit that button. So, audit committees, a board committee with at least 3 independent non-executives on. Their role is to oversee all of that lot. So the executive directors will set the internal controls, manage risk, and produce the financial statements. The executives will do that. That is their job. The non-executives are there, on the audit committee at least, to oversee that the executives are doing this properly. Because we need senior level people, directors, who can then tell the executives if they're getting this wrong. Because if more junior people tell the executives, I doubt the executives will do anything about it. We need some heavy, hard-hitting people to keep the executives doing the right thing. Now, don't be confused by this. The non-executives are directors. They're not going to test the internal controls. They're not going to check the financial reporting. They are there to feed back, but on a very high level. But that's not a problem, is it? Because we know that there are people checking all of these things called internal auditors and external auditors. And the external auditors, of course, are checking the financial reporting. The internal auditors are checking internal controls and risk management. I suppose there's a bit of crossover here, isn't there? Because the external auditors are also going to be checking the internal controls over the accounts. So the audit committee can also talk to the external auditors about what they found wrong with controls. And if that's what the 2 lots of auditors are doing, then fairly clearly, for the audit committee to be able to do their job, the audit committee needs a big hand in liaising with both lots of auditors. What does that mean? It means that the audit committee is going to recommend an external audit firm to the shareholders to vote. And it means the audit committee is going to hire the head of internal audit and ensure the internal audit function gets the resources it needs. However, as we shall see shortly, potentially the audit committee might decide not to hire a head of internal audit. They might decide to outsource the internal audit and get an outside firm to provide the services instead. So that's the appointment, the resourcing side, making sure we have a firm of external auditors, a firm of internal auditors, or a function for internal audit that does the job. The audit committee will also agree the external audit plan before the external audit starts, and the internal audit plan. Now, the external audit, of course, starts at a particular point in the year. Internal audit is going to be a more ongoing thing, but both audit functions, audit committee will want to know what they're doing, how they're doing it before it starts. And at the end of processes, both sets of auditors will pass their reports to the audit committee and discuss their findings before that information is passed on to anybody else. Now, it's not just liaising with both sets of auditors. It is also rather useful that the audit committee, because it must have at least one person on it who understands audit, accounting and similar things, the audit committee can also act as a source of, what's the word I'm looking for here? Consultancy for the finance director. Someone for the finance director to discuss relevant finance related issues with. So there's a selection of the audit committee's roles. What are the benefits of having the audit committee do all of this? Well, it should strengthen the independence and quality of work of both internal audit and external audit. The fact that a specific committee is keeping an eye on them and that that committee is made up of independent NEDs should help tremendously. And I apologise for my rather disastrous spelling there. So that's one benefit. The fact that you've got a specific specialist committee keeping an eye on controls, risk management and financial reporting should increase assurance to the shareholders that controls are reliable, risk is being managed, and the financial statements can be relied upon as well. Also, having one committee overseeing both audit functions should help for the two lots of auditors to communicate with each other because the audit committee can act as a sort of central pin drawing these two auditors together. And there will be occasions when external auditors need to talk to internal auditors and potentially the same in reverse. So there are a few thoughts about what audit committees do, roles, benefits. But time for us to take a look at our first question of this final evening. Knowledge is knowledge, and if you practice enough past questions, you'll see the knowledge that gets asked, and you can almost learn from the answers. It's the practical questions where you need an approach. So at that point, we are going to take a look at June 2014, question number 4. So there we have June 2014 paper. And let's go straight to the requirements as we always do. Part A says explain the advantages and disadvantages for each of Saxophone Enterprises and Cello & Co. of outsourcing the internal audit department. Well, we weren't looking at internal audit, we were looking at corporate governance, but there's no reason why we can't have a crack at that one as well. But before we do part A, we'll do part B, because that was the point of doing the question. In respect to the corporate governance of Saxophone, identify and explain 5 corporate governance weaknesses. And part 2, provide a recommendation to address each weakness. Well, that question sounds very similar to a controls deficiency question, doesn't it? Go explain the deficiencies and then recommend improvements. And when we did controls questions, I said look out for what you are told is not happening. And that will work in this type of question as well. If it says they are not doing something or they haven't got one of these, I'd imagine it's because corporate governance says they should have one of those. Now, the problem with this type of question is, as we saw at the end of last week, the corporate governance code does suggest a lot of things. I'm imagining there are more than 5 weaknesses in this story. The difficulty is they could be any 5 of a number of things. So this is going to give you a good indication of how much corporate governance you currently know. Let's give it a go then. It's Deficiencies and Recommendations. So I think a 2-column approach would make a lot of sense. And when we are explaining weaknesses, we must make sure we explain them. We don't simply copy something out of the question. When we give a recommendation, try to add, just as we did in the controls weaknesses questions. Okay, here we go. Saxophone, trading for 15 years, selling insurance, and has recently become a listed company. In accordance with corporate governance principles, Saxophone maintains a small internal audit department. Well, that's bad news. We can't criticise them on that because they do have internal audit. The directors feel that the team needs to increase in size and specialist skills are required, but they are unsure whether to recruit more internal auditors or to outsource the whole function to their external auditors, Cello & Co. Well, that paragraph is surely aimed at part A of the question, the pros and cons of outsourcing, internal audit, so we'll come back and look at that first paragraph when we do part A. It then says Saxophone is required to comply with corporate governance principles in order to maintain its listed status. Hence, the finance director has undertaken a review of whether or not the company complies. Here we go, folks. Bill Bassoon is the chairman of Saxophone. Okay, well, they should have a chairman of the board, so that's good. Until last year, he was the chief executive. Well, I happen to know that that is the first weakness, but it is certainly not the most obvious one. I'll explain more soon. Bill is unsure if Saxophone needs more non-executives, as there are currently 3 non-executives out of the 8 board members. That will be weakness number 2. He is considering appointing one of his close friends, that's number 3, who is a retired chief executive of a manufacturing company. That might be number 4, as a non-executive. The finance director, Jesse Obo, decides on the amount of remuneration each director is paid. That's number 5. Currently, all remuneration is in the form of an annual bonus based on profits. That's number 6. Jesse is considering setting up an audit committee. Oh dear, they haven't got one yet, but has not undertaken this task yet, as she is very busy. A new sales director was appointed 9 months ago. He has yet to undertake, he has not undertaken, his board training, as this is normally provided by the chief executive and this role is currently vacant. Oh crikey, they've got no chief executive. There are a large number of shareholders, and therefore the directors believe that it is impractical and too costly to hold an annual general meeting. Instead, the board has suggested sending out the financial statements and any voting resolutions by email. Shareholders can then vote via email. I think there are potentially 10 weaknesses. We need 5. So let me tell you what I think the 5 easiest ones are, ones that I would hope you understand. I'm going to start with number 7. Because we've just gone through the roles and benefits of an audit committee and they haven't got one. There is no audit committee. Well, fine, but that's just copying information out of the story, isn't it? We need to explain the weaknesses. Well, we've just seen what the benefits of audit committees are. So, if there is no audit committee, the independence and quality of work of external and internal audit are both under threat, as is the reliability of internal controls, risk management, and financial reporting. Recommendations. When we make recommendations, try to say who, how, when, add some detail. I don't think it's the finance director's job to set up an audit committee. Good corporate governance should go back to the chairman of the board. So my advice would be the chairman rather than the FD should create an audit committee. ASAP. Say who. It should have 3 independent NEDs, of whom at least one should have recent, relevant accounting audit experience. This is an audit exam, and if you can't spot or be able to explain an audit committee weakness, then that is not good. So I would hope that one is fairly obvious. Going back to the story, I also think that you should be happy with number 2. There are currently 3 non-executives on a board of 8 people. Well, you ought to know that at least 50% of the board should be non-executives. Can we explain why this is a problem though? So, only 3 out of 8 directors are non-executives. The Corporate Governance Code requires at least 50% of the board, and not just NEDs, to be independent NEDs, to ensure there are enough of them to control behaviour of the executives. The view is any less and you would lack enough people to outweigh the very powerful and opinionated executives on the board. So what do we recommend? Well, they need more non-executives. If they hire one, they'll have 9 directors and only 4 NEDs, and 4 out of 9 is also less than 50%. If they hire 2 new NEDs, they'll have 5 out of 10, and they're there. Who hires directors? Well, that should be a nomination committee. So that 5 out of 10 directors are independent NEDs. Now there are other ways to get to 50%. If 3 out of 8 are currently non-executives, you could suggest sacking 2 executives, because then it would be 3 out of 6. But that's a ridiculous suggestion. Surely the people on your board are there for a reason, and sacking 2 people just to hit a 50% ratio is stupid. So hire 2 new independent NEDs. 2 down, 3 to go. I also think that you should be happy with number 10. Because the Corporate Governance Code says, let me move that way, says that shareholders and directors should be communicating with each other, and having a general meeting is perfect for that. No meeting, no debate. And why is that a problem? Because if the board aren't listening to what the shareholders want, how do the board know they're running the company in the shareholders' best interests? So it's not just a case of spotting things you want to write. You have got to be able to justify them, at least a bit. Recommendation. An AGM should be arranged, but we need to add some value. Who, how, when, where, how often? Well, it's annual, so clearly once a year. And any discussion points sent to shareholders in advance, you know, giving notice before a meeting. With questions encouraged at the actual meeting. Stimulate communication. I also think you really ought to understand that finance directors do not decide on the pay of each director, partly because the finance director is one of the directors whose pay needs to be set. Finance director decides on pay. They would be setting their own pay. And might be too generous to themselves and to fellow executives. In other words, they've got a fairly clear self-interest threat. You know who sets pay, don't you? A remuneration committee of independent non-executives should be set up to decide pay policies and set individual pay packages for each of the executives. That will help to create some independence to the process, and because non-executives are there to act in the best interests of shareholders, you're far more likely to get sensible pay rather than massively inflated rewards. One more that I think you should be capable of getting. I think I would probably go with this one here, number 3. The chairman is considering appointing one of his close friends. To be a non-executive. Well, the whole point of non-executives is they're meant to be independent. So if the chairman appoints a friend as non-executive, there is a risk the friend sides with the chairman on all matters, giving the chairman too much power over the other directors. And one of the principles of good governance is we don't want one person on the board to have too much power. Well, if the chairman's not going to appoint this person, who should? As above, a nomination committee should select new non-executives, ensuring they are independent, with no close ties to the company or other board members. Now you might be looking at that fifth one, which completes my answer, and quite rightly you may say, hang on my friend, you've already said nomination committee because earlier on we said the board is short of non-executives and a nomination committee should be used to go and find 2 new ones. Okay, fair point. Very good point. Maybe this is not a very clever one to put in as your fifth one then. Maybe we should go for variety and try something else, and I certainly would. All I'm trying to show you is there are 5 in here that are very, very doable. Having got 5 down, my answer is complete. So let me talk you through the other ones. Number 1, the current chairman was formerly the chief executive. Well, that is a breach of corporate governance because it means the chairman used to be one of the executives, and the danger is they will now side with the executives over the non-executives going forward. The chairman is not independent. There's also a danger that whoever the new chief executive is won't be allowed to change anything because they'd be changing the things put in place by the person who's now the chairman, who will override it and say, why are you changing that? It's fabulous as it is. Recommendation. We need to get rid of this chairman. Now we do have a slight benefit that one of the other criticisms is there's no chief executive at the moment. My advice, have the current chairman go back to chief executive, a job they've done before, and appoint one of the current non-executives, assuming at least one of them is independent, as the interim chairman until you decide whether you need someone else to come in and take over permanently. Number 4, the chairman is considering appointing one of his close friends, we've dealt with that, who is a retired chief executive of a manufacturing company. Now I'm a bit 50-50 as to whether this is a deficiency or not. I think boards need a bit of variety on them, and I know this company, it says at the top, is an insurance company, and insurance and manufacturing are 2 very different things, fine. But you don't need every member of the board to be an insurance expert. Bringing in some thoughts from another industry might actually be quite helpful. But you could argue that putting someone on the board from a totally different industry is a deficiency, because how much can they contribute to an insurance company if they don't really know much about insurance? Fair point, I suppose. Recommendation: either try to make sure that your non-executives have some experience of the insurance industry, or if you're going to get someone in from the outside, make sure they have a period of training and induction to help them understand the issues in the insurance industry. Number 6, all remuneration is an annual bonus based on profits. Directors' remuneration should be a mixture. Salary, so your regular pay for coming to work, plus some performance-related stuff. If you make it all performance-related, what if the company halfway through the year already knows it's going to make a loss? You've now got directors who won't be paid anything. What's their incentive to come to work? So yes, we like performance-related, but it should be a proportion of pay. It should not be entire pay. So recommendation, redo pay packages to ensure they have industry average salaries that are fixed. Keep the bonus, but only as a proportion of pay, not the whole thing. When we discuss the weakness and recommendations, do we strictly need to add company name? Sorry, I don't understand that question. I'll carry on. Try and phrase it differently because I don't understand what that means. Number 8, a sales director was appointed 9 months ago. He has yet to undertake his board training. If the sales director has not been trained, the chances are they don't understand their corporate governance duties, their legal duties, and possibly don't understand how they fit into this board and its various committees. We could end up with breaches of law, breaches of corporate governance, directors not doing their duties. Recommendation: as soon as possible, the sales director needs to go through that formal training. And since this is corporate governance, you don't need the chief executive to do it. The chairman should organise someone else to do it. As in referring to the question scenario. Still not sure I understand the question. There is a story. Your answer must talk about the story. If it's clear you're talking about the story, I don't think it's important if you actually write the company name in your answer, because you're talking about the story. That's where the deficiencies have come from. I really don't understand what you're saying, to be honest. Now, we've already dealt with the fact that there's no chief executive in terms of sorting it out, because we've said the current chairman should go back to chief executive because we don't want him as chairman. But why is not having a chief executive dangerous? Well, there's no one to lead the executives running the company, which means no one's in charge of company strategy. This is like not having the captain on a ship. There's no one in charge. And it also will mean that the chairman has a huge amount of power, because the two most important people on a board are chairman and chief executive, and if one of those doesn't exist, the other person has total power over what this company is doing. Oh, okay, so I did understand the question. Cool. So that is how I would be looking at 4 Part B. As always, when you're looking for points in a story, she will give you way too many. Go and pick those that you are comfortable explaining. You don't have to explain them all, but you must try to explain. Don't just copy stuff out. Okay, so we've done some corporate governance. Hurrah! But we also need to revise internal audit. And rather helpfully, one area of internal audit that might come up is the costs and benefits, advantages and disadvantages of outsourcing internal audit instead of having it in-house. Now, this is just a knowledge question. This is a standard list of pros and cons. There's no practical side to this, really. The story tells us that they've currently got a small internal audit department and they are trying to decide: hire more people and make the department bigger, or give up on the internal audit department completely and outsource the work, and specifically to the external auditors. Given that this is knowledge rather than practical, I'm not going to write the answer out. I'm just going to go for an answer plan. The question says, what are the pros and cons of outsourcing the internal audit work to Cello & Co., the external auditors? But it says, what are the pros and cons both to the company, and that was worth 8 marks, and also to the audit firm, and that's only worth 2. And it's interesting that the last time this question came up, it was exactly the same. 8 marks on the company, 2 marks, pros and cons to the audit firm. Okay then, here we go. Now surely the benefits of outsourcing anything are likely to be pretty similar. I mean, why would you take a taxi, i.e. outsource the driving, rather than drive somewhere yourself? Well, if you take taxis everywhere and don't drive yourself, you don't need to have a car. And that saves you the costs of maintenance, insurance, and all the other running costs of a car. Likewise with internal audits, if you outsource it, you can avoid staff training costs, office costs, because you'd need an office space for the staff, and desks and chairs and computers, and you'd have to pay them salaries and they'd want holidays. So one benefit of outsourcing internal audit is you save the costs of employing and training your own staff. However, there is a negative side because you already have a small internal audit department, and if you decide to get rid of it, you might have to pay redundancy costs for the current internal audit staff you let go. Now, maybe they can be employed somewhere else in your company, and if that's the case, good news, I suppose. But if you outsource something which you already do in-house, then you're going to have to get rid of the in-house stuff, and that could cost you quite a lot of money. Now, of course, there are clues in the question here, aren't there? It says there's currently a small internal audit department, and they are looking at enlarging it so they can do more work. And one of the benefits of outsourcing is it might be possible to get additional services immediately, because you don't have to wait to recruit the staff yourself. I mean, in theory, if you phone up Ernst & Young, they might be able to supply internal audit services very quickly because they've already hired their staff, haven't they? And another positive to the company of outsourcing is you get, of course, the expertise and the experience of the outsource firm. But I can think of a negative. Taxis are expensive, aren't they? I mean, the taxi driver knows where they're going, I hope, but you have to pay for the luxury of the expertise. And if you outsource internal audit and pay other people to do it for you, the outside specialists might not understand your company and your company culture. If you drive yourself, you can take whatever route you like. If you are getting a taxi driver to drive you, maybe they'll drive you a way you don't really like. Another danger with paying outsiders to come into your company and check things like controls and risk is an increased risk of confidential company information disappearing out of the company. You're letting outsiders see the inner workings of your company. 8 marks in here. I think we need a fourth benefit. Benefit of outsourcing. Well, the outsourced specialists are more independent, which hopefully gives you a better chance of hearing the truth about how well your systems are working. Now, I've run out of space in that box, but I would have to say when making that point, better independence, but a lot of that independence is going to be threatened by the fact that the company is considering outsourcing this to its own external auditors. Now, where do I put that in my answer? I could put it there, or maybe it goes in here. I've got 2 marks to talk about the pros and cons of all of this to the external auditors. Well, there's a fairly obvious benefit to the external auditors. They will earn more fees because they're doing 2 jobs. And even better than that, you get more fees and you don't have to spend time understanding the client because you already are their external auditor. You could then argue that when you do the internal audit work, you get better understanding of the client, and that should help your external audit going forward be better quality. Downside, your client wants to give you more money to do more work for them. Is there a downside to that? I suppose this is the place where you could say that the independence of the external audit is going to be threatened if internal audit work is also done. Why? Self-review threat. You test the controls as the internal auditor, then you come to do the external audit and you say no need to test the controls because I tested them last week when I was doing the internal audit. You're not checking the controls because you assume the work you did as internal auditor is sufficient. What if you did it wrong? Self-interest threat, because now going forward you will get 2 lots of fees from the same client, which could push you above 15% of your total fees, meaning you are too dependent on this company for money. Anyway, if you want good practice of outsourcing internal audit, pros and cons, this is a very good question because it makes you think about it for a lot of marks and not just from the company's perspective. So, we've managed to do some internal audit. Well done us. On the subject of internal audit, a few other little bits of knowledge to go through just to remind you what you might be asked. What does internal audit do? Test controls at the company is the main thing, but also companies want their assets to be safeguarded, looked after, so the internal audits will take the asset register and go around the company premises, making sure that assets are where they should be, in good condition, being looked after, etc. Companies do not want fraud. If there's any suggestion there is any, get the internal auditors to go do a fraud investigation. Companies do not want to break the law. So internal auditors can do a compliance audit and check that laws and industry regulations are not being broken. When the board are making decisions, they are using internal financial information, management accounts, board reports. If they're making decisions on those numbers, I hope those numbers are right. Why not get internal audit to check the accuracy of board reports, management accounts, in other words, the internal accounting information, not the external, because the external auditors check the financial statements, but the internal stuff. And finally, in running my business, I want it to be as profitable as possible, efficient, and achieve its aims. So I'd like the internal auditors to do some value for money audits. Remember the 3 E's? Economy, efficiency, effectiveness. Economy. Could we have bought those items or carried out that process at the same level of quality but cheaper? Efficiency. Could we use our assets and get a better return on them? Could we use them better? And effectiveness is the company and also each individual department of the company achieving its aims. So ask yourself, what are your aims? And then check if the company and each department are actually achieving those. So there's a few thoughts on what internal audit does. Another potential question with internal audit is a comparison of internal audit versus external audit. External audit is typically a legal requirement, whereas internal audit is usually voluntary. But as we saw in a question earlier, it might be recommended by corporate governance principles. External auditors have formal audit standards to follow, whereas internal audit has very few standards to follow. And it's much more up to the auditors themselves to work out professional ways of doing things. Then there's the role, of course, external audit. Check the financial statements. Internal audit. Check things like controls, fraud, etc. Not going to write it all out again. External audit must be independent. They must be outsourced. You can't use your own staff. Whereas internal audit, there is no independence requirement. So if you want to use your own staff, you can. So we've gone through some internal audit, done a question with some in. We've gone through corporate governance as well. What I think we ought to do now is have a look at another question. Not internal audit this time. We're going to go back to something a lot more core. We're going to jump forward from June 14 and take a look at June 15. And we're going to have a look at question number 3. So there we go, June 15 paper. Some nice multiple choice questions on there. Just while we're going through the paper, let's see what came up. June 15, 5 ethical threats and how to deal with them. 5 components of a company's internal control: control environment, control procedures, information systems, risk assessment, monitoring. 1 mark on each of those. Nice, easy question. Describe a test of control which the auditor of Bonsai would perform if we were doing this question. Tests of control. Well, the auditors have 5 basic tests: analytical, enquiry, etc. And I find tests of control are typically the middle 3. Inquiry, inspection, observation. So if you want to test the list of controls that is in this story, you could inquire of staff at the company, does the control happen? You could inspect signatures on documents, because if someone authorises something, they're likely to sign it, for example. Or you could observe, actually watch the control procedure happen. Or if it doesn't look like the control procedure is due to happen for a while, meaning you can't see it, try and make it happen by using test data. So remember that, a computer-assisted audit technique. You throw a fake transaction at the system designed to try and break the system, and hopefully the system will stop that happening, proving the control is there. And as long as you know that, testing the controls in this particular question is really not that difficult. But the question we're going to have a look at is number 3. As you can see, it's similar to another question that we have done. There are 2 stories, and the question says, for each of the 2 issues, the 2 stories above, discuss the issue, including an assessment of whether it is material. So what is the issue? Is it material? Recommend 1 procedure. So that's going to be AEIOU. The audit team should undertake to try to resolve the issue. So let's just summarise. Issue, materiality, 1 audit test, and describe the impact on the audit report if the issue remains unresolved. You've got to do 4 separate things. The total marks will be split equally, so it's 5 marks for the first one and 5 for the second. 4 separate things for 5 marks. So one of those 4 things is worth 2 marks. Well, you've been told 1 audit procedure. You'll only get 1 mark for materiality, because that's calculation, too easy. So you've got 3 marks left to cover describing the issue and the impact on the audit report. Also note it says audit report extracts are not required, and they never will be. You have to describe the effect on the audit report. You will never have to write the actual audit report words themselves. Issue, materiality, 1 audit test, impact on audit report. Seems very clear, but a lot to do for the marks. So let's go read it. You are the audit manager of Chestnut and are reviewing the key issues identified in the files of 2 audit clients. Palm's year end was the 31st of March 2015. Remember, this question came up in June 15. So the year end was 2 and a bit months ago. The draft financial statements show revenue 28.2, receivables 5.6, PBT of 4.8. Now we need to calculate materiality. 1 calculation will be enough to get that mark. And if you're ever not sure, compare it with profit. You can't go wrong comparing it with profit. The fieldwork stage for this audit has been completed. So the audit staff who went to the client have finished their work and come back to the office. A customer of Palm owed an amount of $350,000 at the year end. testing of receivables in April highlighted that no amounts had been paid to Palm from this customer as they were disputing the quality of certain goods received from Palm. Finance Director confident the issue will be resolved and no allowance for receivables was made with regards to this balance. So it's not been written off, no provision. Five marks available. What is the issue? The issue is that this debt looks in doubt. I'm not saying it definitely won't be received, but clearly if there is a dispute, that is a doubt. And receivables should be valued at the expected amounts received. Or fair value, I suppose. So this debt needs to be provided for, doesn't it? Materiality. Profit before tax 4.8, the debt is 350. So 350k over 4.8 million. Is 7.3%. And that is material to profit. And if it's provided against, bad and doubtful debt expense would go up, so profit would go down. And that seems to me the most sensible calculation to do. If you're not sure what to divide it by all three numbers you've been given. Why not? There is no negative marking and calculations like this take a matter of seconds. But profit is probably your safest bet. So, a debt owing at the 31st of March of 350 had not been received during April, and we know there is a dispute. Always watch the dates, because today is early June, and it seems to me that the audit staff last checked this back in April. What's happened in May? So I think the best procedure is going to be inspect correspondence between our client and this customer during May 2015, always say why, to see if the dispute is getting any better or worse, or if the customer has agreed to pay any of the balance. The clue here are the dates. The audit staff checked this, but it hasn't been looked at in a few weeks, and surely it's changed since then. Never forget your responsibility for subsequent events runs all the way up until you sign the audit report, and something like an outstanding receivable could be changing late on in the audit if it's being paid Or maybe your client will agree that the customer doesn't have to pay, in which case it definitely has to be written off. So anything that is outstanding at the year end must be reviewed throughout the audit process, all the way up until the audit report is signed at the end. Audit report. Remember, there's 5 marks available here. I doubt we're going to get more than 1 for the issue, because the issue seems pretty simple. We'll only get 1 for materiality, and we only are allowed to say 1 procedure. I think we need 2 marks for the report. And if they don't provide against this receivable, based on the information that we've been told so far, I think we have discovered a material misstatement in the financial statements, and therefore we would want a qualified opinion except for. Well, that's 1 mark. How do you get the 2nd mark? Well, you could argue why it's not pervasive, but I think this best 2nd mark is to say that an explanation of the mistake and its impact on the financial statements should be in the basis for opinion section directly under the opinion. I've said it many times, I will say it again. It is not just answering the questions and the content. You must look at the number of marks available. Any student who says an exam is time pressured is probably ignoring the marks and trying to write way too much. There are 5 marks available, try and fill them out. And the second one is called ASH. Issues, materiality, 1 test, and impact on audit report if not dealt with. ASH is a new client of Chestnut. Its year end was 31st January 2015, and the firm was only appointed auditors in February 2015. We've been appointed after the year end, as the previous auditors were suddenly unable to undertake the audit. The fieldwork stage for this audit is currently ongoing. Is that a clue? In the last one, the staff had come back to the office. In this one, our staff are still at the client's premises. Does that mean that the audit test we are going to suggest will involve the staff doing something at the client's premises because they're still there? Might do. The inventory count at Ash's warehouse was undertaken on the 31st of January 2015, and we weren't the auditors, which means we won't have been there, and was overseen by the company's internal audit department. Understandable. The year-end stocktake is an internal control, and as we know, internal auditors like to keep an eye on the quality of a company's controls. Neither Chestnut, that's us, nor the previous auditors attended the count. Detailed inventory records were maintained, but it was not possible to undertake another full inventory count subsequent to the year end. Draft financial statements show a profit before tax of 2.4 million, revenue 10.1, and inventory of 510. Let's go for the easy materiality mark first. The inventory is 510,000. Profit was 2.4 million. Therefore, Sorry, I've immediately forgotten what the number was. I think it was something like that. So inventory, which is of course in cost of sales within profit or loss, is material to the profit or loss account at least. 1 mark for materiality. What's the issue? Well, the issue here is I don't know if inventory is wrong because we lack evidence over inventory at the year end as we did not attend the year-end count. And neither did the previous auditors, so there's no point asking them for any records they might have. For whatever reason, they didn't attend either. Oh dear. I'm going to go for the audit report next because I think that's easier than working out a procedure that might be done in this situation. If you lack evidence over one material item in the accounts, then you have a material lack of evidence, meaning, yet again, a qualified opinion except for. Again, I am struggling a bit with what the procedure might be, so this time, because I might be short of an answer or two, I am going to say it is not pervasive as only the inventory balance is affected. But I will also say, as I said above, that the lack of evidence, being the modification of the audit opinion, will be explained in the basis for opinion section directly under the opinion. But I need to have a go at some sort of audit test. This one is much harder than the first one, I think. We don't know how much inventory they had at the year end, and it's now 4 months after the year end, so unless you own a time machine, how are you going to go back? Well, I think there are 2 possible ways out of this. You could ask the audit staff who are currently still at the client's premises to go count how many items of a few sampled product lines they have today, and then add back anything that's been sold of those products, subtract anything that's been purchased between February, March, April, May, and that should tell you how many they should have had on January the 31st. But given we are 4 months after the year end, that sounds very tricky to me. And there was a clue in the story that something else could be done. It says the internal auditors were there. I would therefore ask the internal auditors to supply us with their records from the stock take. Now, I don't know what work they've done, but if we can see what tests, checks they did, ensure their work adds up, looks professionally done. I suppose we also ought to assess the qualifications, experience, and independence of internal audit staff to see how reliable they look. Oops, sorry. And if after doing all of that, this work looks okay, maybe there is enough evidence from the work they did to fill the gap of the work that we would have done if we'd been appointed in time. That, I think, is the better solution. But if you did suggest checking quantities today and trying to track back 4 months, I suppose that might work, but that sounds very complicated to me. So there we go, some more practice of substantive procedures, a bit of accounting knowledge, some materiality calculations, and of course, very importantly, a chance to have some practice on audit reports as well. Right, we have been going for an hour and a half. It is time for us to have our little break. And when we come back, some final things to look at, bit more practice to make sure we have covered all of the bases before next week's exam. Now, obviously, we are coming to the end of revision. We do still have the mentoring session on Friday, but if you do have any things that are bothering you about the course-specific knowledge, technique, or anything else, don't feel you have to wait to mentoring on Friday. Ask me after break if you prefer. We will take a 15-minute break at that point. We will restart at approximately 7:45. I'll see you then. Yes, can I explain that at 7:45? First thing I'll answer when I come back, okay? Oh, crikey, 2 questions. I'll start answering them when I come back, all right? See you in 15 minutes. Okie dokie, hello. Oh crikey, we've got another question as well. Okay, yeah, we can answer all of those. Just before I answer those questions, during break I had a little look at the ACCA's website and a bit of a surprise. Now I don't know if this is a mistake or a policy decision perhaps, because they changed the format of the paper. But the September F8 exam with solutions has appeared on the ACCA's website. I have literally only just seen it myself. I've barely had a chance to read it. But if you want to know what the new format exam looks like, you've now got two options. The specimen paper on the website, but now the actual September paper with solutions has appeared. I have no idea if the September paper is there for any other papers, but it is definitely sitting there for F8. If it is a mistake by the ACCA, they'll take it off again tomorrow. So if I were you, straight after this class, go to that website and download it while you've still got the chance. Right, we have some questions. Can you briefly explain window dressing? Yes, it's where the directors cheat in the accounts to make them look better than they actually should be. So recognising sales that you haven't actually earned yet, ignoring expenses, deliberately depreciating your assets over too many years to slow down depreciation and reduce expenses, not providing for things or accruing for things that you should do to again reduce expenses. Anything to make revenue artificially high, expenses artificially low, assets look too high, liabilities look too low. That's all it is. It's cheating. If we are relying on internal audit work, does this still qualify the audit report? Interesting question. That all depends on whether you think the work that the internal auditors did replaces enough of what you would have done if you'd been there. So it's up to you. It totally depends. If you don't think the internal audit work is enough, then you will still say lack of evidence. If, on the other hand, the internal auditors are very reliable looking people, the work they've done is very detailed, and they basically did all the testing you would have done if you'd been there, maybe you'll rely on them. Up to you. And I came across a question on internal control weaknesses in a company. There are quite a few of those questions. The question asked to prepare a letter to company addressing these weaknesses. Is it an audit report format or just a letter format? Okay. So if you get a question that looks like this, actually let's have a number in there. 6 control deficiencies, recommend improvements. That question might be worth 12 marks because 6 deficiencies, 6 improvements. Fairly obvious. But it might be worth 14 marks. And the reason it might be worth 14 marks is it will say, note, a covering letter is required. Meaning that that 14 is 12 marks for that lot, and the other 2 is for the covering letter. So in the real world, as auditors, if we are going to send something to our client, what would we send? Well, we'll send the big report that says deficiencies, recommendations. But you can't just send that. Good idea. So did I. You can't just send something like that to a client because they'll look at it and go, what's this? If you send anything detailed to a client, you include a covering letter. And the covering letter does indeed need to look like a letter. So it will have your firm's address, the client's address over on this side, the date, 5th of December, your exam day, 2016. Dear sirs, madams, whatever. So it will look like a letter. Now, a reminder, and it will say at the end, yours faithfully. So if this does come up, and it doesn't come up very often, and is only worth a couple of marks, but if they do say covering letter, you still do the deficiencies and recommendations in columns, but you add a letter that would go on front of it. Make it look like a letter. And then the question is, what's going to go in the content? And the content needs to say the following 3 things. The whole point of a covering letter is to explain what you are including in this letter. So we enclose our analysis of control weaknesses and recommendations for improvement. So as with any covering letter, first thing to do is explain what is under the cover. What are you sending? Then you need a couple of disclaimers. Please note, 1, this is not a comprehensive analysis of your controls, just those deficiencies we noted whilst auditing your financial statements. Because you will only have tested the controls that you felt were worth testing as part of the audit. You might, for example, have done full substantive testing on some things and not bothered looking at the controls at all. Secondly, please do not show this report to anyone outside your company without our prior written permission. Now that letter is don't do this, don't do that, which is a bit negative. So before the yours faithfully, I think I'd try and make it sound a bit more positive by saying we'd like to thank you and your staff for their help during the recent audit, or something like that. We look forward to further working with you, just to make it feel a bit nicer. But in terms of marking it, say what the letter's about, 2 disclaimers, make it look like a letter, and you've got the marks. And that is the end of that. Okay. Now, there is something that joined the F8 syllabus in September this year, and rather helpfully, although too late for this course as it turns out, we can now see what the exam question looks like on that topic, because they've published the September paper. Somewhere in the long questions it asks something about quality control. Audit Standard 220. I think, if my memory is correct, that this was the very last requirement in the very last long question on the paper. I think. But I might be wrong. And it was only for about 4 or 5 marks, again, if my memory is right. So what do you need to know about quality control? It divides into 2 things. And we start with quality control for the firm, your audit firm as a whole. So imagine you were starting a new firm of accountants tomorrow. You've got no clients yet, but you're starting to set up your systems. How do you make sure that from day one, good quality? Put someone in charge of it. Appoint a quality control partner. That quality control partner's job will be to set up documented audit processes that comply with the audit standards, of course. Arrange training for the audit staff to make sure they know what those documented processes are. They will also arrange something called a cold review process to quality check audit files of finished work so we can help learn if we are making any consistent mistakes. Please note that is not the same as a hot review because these reviews are after the work has been finished. So if you discover a quality problem, it's too late. Game over. But it will help you learn for the future. Other ways that audit firms can achieve quality. Be very careful who you hire. Reward quality work and discipline poor quality, and the message soon gets out that if it's not quality, we're not interested, and that will help create a culture of top quality work. Now, she might ask about that. What was asked in the September paper, though, was on the other side of the screen. You've now won your first client. Well, your staff are trained, you've got audit processes, all looking good. Now you send your staff out on this job. How do you make sure they do good quality work? Well, 3 big words here are going to be direction, supervision, and review, especially of the more junior staff on the team. Direction is telling them what to do and how to do it. Supervision is monitoring them while they do it to make sure they are doing it right, and if they want to ask any questions, you can help them. And review is checking the work they've done afterwards to make sure they've done what they should have done. But also, when you're sharing the audit work out amongst staff, make sure you are sharing it based on the staff's skills and experience. Should be pretty obvious this, but audit trainees should not be assessing complicated valuations, financial instruments, assessing going concern, assessing the risk of fraud. These are all things that require experience. The more basic work, making sure that we've had a letter back from the bank confirming balances, checking year-end bank reconciliations, making sure customers, if asked for their balances, have replied, suppliers that they've replied. And if the client is listed on a stock exchange or is deemed high risk, for example, it's a new client, or there is an ethical threat on this audit, then someone senior should be checking the quality of this work before the audit report is signed. Because that way, if there is a problem, the problem can be put right. And that is quality control, not complicated. But the only problem we have is we have precisely one past exam question, and that only appeared on the ACCA's website today. So a bit late in the day, ACCA, thank you very much. Okay, there are two things left that I want to do. Obviously, if you've got questions, feel free. And one thing I would like to do is on the most important topic on the syllabus, and I think this is a very good way to help bring this course towards a conclusion. The most important exam area for marks is substantive procedures. We've looked at two basic styles of question, haven't we? One question that will say, what audit procedures would you do on, and then it picks a number, you know, bank and cash. In fact, we did bank, didn't we? Bank, payroll expenses, any other number in the accounts. And we've looked at the questions where they give you a couple of little scenarios and they don't tell you what the numbers are you have to check. You have to work that out from the scenarios. Now we've done a couple of those. We've only, I think, done a fairly small amount of testing an actual balance. So let's have a go at coming up with tests, and let's assume that our client, the exam question asks for substantive procedures on trade receivables. How would we go about this? No other information provided. You've just been asked to do that. Well, as I've told you, I think there are three ways of coming up with ideas. Because when we are doing substantive procedures, we test assertions by doing procedures on evidence. Trade receivables are on the statement of financial position. Therefore, the assertions that relate to the statement of financial position that we will need to test are completeness, and the opposite one, existence. We need to check the valuation of trade receivables, classification, presentation, and rights and obligations. We have 5 types of procedures available to us: A, E, I, O, U, analytical, enquiry, inspection, observation, and recalculation. And evidence, that's DAR 3. Think documents, think assets, Think, what could we ask the directors? Which accounting books should we be looking in? And is there a third party who is worth asking as well? Now, on the subject of DADA 3, what sort of documents might exist to do with trade receivables? Well, invoices, bank statements, correspondence between our client and their customers would all seem valid. What assets are relevant to trade receivables? Well, the receivable is an asset, and we're rather hoping it turns into another asset, cash. What about the accounting books that are relevant to receivables? Well, there's the sales ledger, which has a separate little account for every customer. There's the sales day book, where all the invoices get listed. There's the cash book, where the money coming in from customers gets listed. And third party is going to be the customers. So with all those thoughts in mind, I can now stare at what's up on the screen and immediately come up with a lot of tests. Now, as I've said to you before, it all depends on you as to which of those three lists is easiest to use. But as we have seen, there are past exam questions that ask you for specific assertions. And when we did the bank question, it asked us about AEIOU and we had to come up with a test for each of them. So I would practice using all three lists. So I'm going to pick from all three lists to come up with ideas. And I'll start with AEIOU and I'll use the A, analytical. Well, analytical is comparing. So I would compare what? Well, I can compare with last year, compare with budgets. And I'm thinking comparing receivables with last year. Problem. If we've sold more, receivables will be higher this year. Surely if we've sold less, it will come down. So I need to compare receivables but build in the sales figure somehow. And that is called receivables days. So compare receivables days with prior year to see if it has unexpectedly risen or fallen, as this may indicate receivables are too high or too low. So I guess that comparison is probably testing the valuation of receivables. Let's go for variety. Let's go DADA 3. And the first one that jumps out at me is the 3. I am going to make inquiries of my client's customers asking them to tell me the amounts they owe my client at the year end, to help confirm they owe this money to my client, and that helps to check the balance exists, and also it does belong to my client and not someone else. And since I'm checking the amount, it also helps to check valuation. Let's now have a go at using the assertions and see if that can come up with a test. Let's start at the top. Completeness. How do I know receivables are complete? Well, they are complete if they include every balance owed by a customer at the year end. So I'm thinking, let's use an analytical test and compare the list of customer balances at the year end with last year's list to see if any of last year's customers are not on this year's list, and ask maybe the sales director why they're missing. Now, the most obvious answer you'll get back is because we don't sell anything to that company anymore. In which case, fine, that explains it. But the sales director might say, I've got no idea, we sell loads of stuff to those guys. I'm surprised they're not on the list. It might indicate a missing balance. And that is the best way to go about coming up with substantive tests. Think assertions, A-E-I-O-U, D-A-D-A-3, and try to use all of them. Now, I've only come up with 3 tests there. I could carry on doing that all night. E, inquire. Inquire of who? We've done third parties. Directors. Ask the directors to confirm that in their opinion, all receivables at the year end that have not been provided for will be received. Get them to confirm that they are confident that amount will come in. I, inspect. Let's inspect a document. Inspect correspondence, as we did earlier tonight, with customers to assess if there are any disputes about balances owing at the year end. Inspect, let's check an accounting book. Inspect the cash book after the year end and see how many year end balances have now been paid off. What about the ones that haven't been paid off yet? Ah, good point. Well, you've inspected correspondence to see if there are any disputes. I might also look at the payment history of customers who owe money, because possibly if their history shows they always pay late, that gives me some comfort that despite the fact the balance is old, they do have a habit of paying eventually. If they've always paid very much on time and suddenly they're not paying, that would indicate a problem, wouldn't it? It only takes practice to get good at this, but you do need to practice. Right, we have spent a lot of time doing long questions, but we need to remember that there are also knowledge parts of this course and multiple choice. So to help give us a nice range of multiple choice practice, I think it would be a neat idea at this point to go back to the June 15 exam paper and have a look at some of the multiple choice questions that came up. Now, please don't forget, when you look at the September 2016 paper, the multiple choice questions, there'll now be 15 of them, not 12. They're all worth 2 marks. Some of these are worth 1 mark. And instead of there being individual MCQs, as we have here, there will be a story and then 5 MCQs coming from that story. Okay. Number 1, which of the following audit procedures for obtaining audit evidence is correctly described? A rather odd exam question in my mind, because you don't need to know anything about auditing to be able to answer this right. Recalculation. Well, recalculation, re means again, and calculation means doing a calculation. So if it doesn't say reperforming a calculation to make sure it's been done right, it can't be right, can it? Recalculation involves the auditor's independent execution of procedures or controls which were originally performed as part of the internal control of the entity. No, that's reperforming something. Recalculation is doing a calculation again. So that's not right. Confirmation consists of seeking information of knowledgeable persons within the company or outside the company. Well, that sounds like it could be right, but I do have a problem with this because the audit procedure I know and love is called enquiry and confirmation. Enquiry is seeking the information. Confirmation is receiving the answer back. And this doesn't say anything about receiving an answer back. It just says seeking the information in the first place. I think this is the meaning of the word enquiry. Now, you only make an inquiry to get a confirmation, so it might sort of be right, but I'm not sure. So let's look at the other answers. C. Reperformance consists of checking the mathematical accuracy of documents or records. Well, if you're checking the mathematical accuracy, that's that one, isn't it? So A and C have had their definitions exchanged. Is D more assuring to us, more convincing than B? Observation, right, don't read anything else. What is observation? It is to observe, to watch something happen. Observation consists of looking at a procedure or process being performed by others. Absolutely correct. So B, which I was a bit 50-50 on, can't be right because D is definitely right. Well, as long as you can speak the English language, question 1 is easy. Question 2. Auditors are required to undertake an overall review of the financial statements as the final step before they form their audit opinion. Last thing we do on the audit. As part of this process, they undertake a number of procedures. Which of the following procedures would an auditor not undertake as part of overall review? In other words, we wouldn't do this as the final step on the audit. Review the financial statements to ensure they are consistent with our knowledge. Yes, we do that right at the end, because right at the end is when we have the most knowledge of the client. So that one is part of overall review. Perform analytical procedures on the financial statements to form an overall conclusion on the financial statements. We do that right at the end because the accounts might still be changing as we get towards the end. Undertake a review of subsequent events to identify whether any adjustment or disclosure is required in the financial statements. You might remember that when we looked at ISA 560, subsequent events, I drew a diagram. Client, year end, AGM, and I said that we have an issue here because if that's the date the directors will sign the financial statements, in between the client's year end and the date the directors sign, Accounting Standard 10 events after the reporting period are occurring. They are part of subsequent events. And as an auditor, I have an active duty to be auditing those events all the way up until the point that I sign my audit report. I don't just review them at the end. They are happening from the moment the client's year end finishes. So this is not a final step. It's done throughout the final audit process, not right at the end. And because of that, the answer to number 2 is C. It's not part of overall review. D. Reviewing the financial statements to ensure compliance with accounting standards and local legislation disclosure. These are the checklists we fill in at the end of the audit. We sit with the final set of accounts. No more changes will happen because there's no point checking them for all these little bits and pieces that should have been disclosed until you know everything that will be added has been added. So that one is done at the end. So sorry, it's not D. The answer's C. Question 3. Which of the following is not an inherent limitation of internal control systems? Well, the inherent limitations of control systems are largely humans do them. And humans break the rules, override controls, and are subject to human error. And there are some humans, and there are some humans. So B and C will almost certainly be inherent limitations. Human error C, employees may cheat and collude B. Yep, those are inherent limitations. People. Insufficient segregation of duties can be avoided, meaning it's not inherent. You can get rid of it. Inherent means something that's just there and you've got to put up with it. If you employ more people, you could split tasks between them. So the answer is A. Question number 4 is possibly the most stupid question I've ever seen, but hey. Which of the following statements relating to international standards on auditing, if any, is or are correct? International standards on auditing, ISAs, are issued by the International Accounting Standards Board. No, they're not. They're issued by the International Audit and Assurance Standards Board. Strangely enough, the International Accounting Standards Board issue accounting standards. Bit of a clue in the name there. So that's rubbish. Number 2. In the event the audit standards differ from local legislation, so law in a country, auditors must comply with the requirements of the audit standards. So if audit standards say one thing, and the law in the country where you are says another, you should break the law. Does that even sound likely? The rules say you must break the law. No, they don't. That is utter rubbish. Audit standards are basically guidance on how audits should take place. If there is a law in your country that is inconsistent with the audit standards, then you can't follow that audit standard, can you? It's not your fault. You can't break the law. Both of them are rubbish. The answer's D. Number 5. Which 2 of the following statements regarding the use of analytical procedures during the planning stage of the audit are correct? Now, under ISA 520, analytical procedures, they are done at 3 stages of the audit. They are done at the beginning, planning. They are done in the middle to get evidence, because AEIOU, they're the A in there, and they're done as part of the final overall review at the end, as we saw in MCQ number 2, I think it was. So the question is, which 2 of the following statements regarding the use of analytical procedures during the planning stage, the beginning of the audit, are correct? Number 1, useful when forming an overall conclusion. Well, overall conclusions are at the end. So that's not right. Analytical procedures can be used to obtain relevant and reliable audit evidence. Well, that's the middle stage. So that's not right. Neither of those are to do with planning. When we did risk and response questions, one of them we did had ratios in it, which we compared this year versus last year. Analytical. Why were we doing that? To highlight audit risks and anything that looked weird. Unusual, risks. 3 and 4 are correct. So that one is testing whether you understand analytical is done at the beginning, middle and end of the audit. So a useful question to do, as it now means we have revised Audit Standard 520. Number 6 is only worth 1 mark, but it is very important because it is testing your understanding of assertions. One of these tests is testing completeness. So remind yourself, what does completeness mean? It means we are checking to see if the things that should be included in the books have been included. Select a sample of assets included in the non-current asset register and physically verify them. That's not checking that the things that should be there are there. You're checking the things that are there are real. That is a test of existence. So it's not that. Review the repairs and maintenance expense accounts to identify any items of a capital nature. Well, that is a test of completeness. You are looking somewhere else where they might have mistakenly put non-current assets, so you can find them and get them added to the non-current assets figure to make sure it's complete. The answer is B. C, assets disposed of agree the sales proceeds. Well, proceeds are part of the calculation of the profit or loss on disposal, and that is a valuation issue. So the answer was B. Very important you understand number 6. Ooh, a bit of corporate governance in number 7. Which of the following is not a principle of the UK Corporate Governance Code? Shouldn't it be classification? B. It is possible for some tests to test more than one assertion. I agree that when money is spent on refurbishment, it could be classified as asset or repairs. So if you're checking that the things in repairs are genuinely repairs, I totally agree with you. You're testing classification. But you are also testing that everything that should be in assets is assets. So that test tests both classification and completeness. It tests both. So yeah, good point. Very good point. We saw that earlier though, didn't we? Because when we wrote to customers to confirm balances, when I did the receivables thing, when they write back and say, yes, we confirm we owe this amount to your client proves it belongs to my client, rights and obligations. They confirm the balance exists and they confirm the valuation of it. 3 assertions for the price of 1. Number 7, corporate governance. There should be a rigorous and transparent procedure for the appointment of new directors. That just sounds so good, it has to be true. The board should use the AGM to communicate with investors. We saw that in a question earlier tonight. The non-exec chairman should decide on remuneration. No, it should be a remuneration committee. So the answer is going to be C. Let's check D. All directors should receive induction training on joining the board. We saw that in the question earlier. New sales director, no training yet. So yes, they should receive training. The answer is C. Not that difficult. I said number 6 is important. Number 8 is also very important. It's not just that it's worth a mark. It's the fact that understanding this will help you get good marks on the long questions as well. Which of the following is a substantive audit procedure. So guess what the other two are going to be? This is testing if you can spot the difference between tests of control and substantive. Tests of control, check, process. Substantive, checks, numbers. Inspect a sample of clock cards for evidence of authorization. Authorization is process. First one's a test of control. Recalculate. This is already looking good for numbers, isn't it? A sample of payroll deductions to confirm accuracy. You are checking the numbers in the accounts are right. That's substantive. But for safety, let's check C. Attempt to access and make changes to the payroll master file using the logon for a junior clerk. Well, the junior clerk should not be able to do that, so you are checking process. And you are checking process by using a fake attempt to get into the system. Another example of test data. Hopefully, with the exam 7 days away, you're seeing these and thinking, okay, these aren't too bad. The next one is a little more difficult. Because it's about subsequent events, one of the more technically difficult areas of auditing. Which of the following statements regarding subsequent events, if any, is or are correct? Auditors do not have a responsibility to perform procedures to identify subsequent events after the date of the audit report. I agree. Identifying things is an active responsibility. You have to go and find them. When you sign the audit report, the end of your active duty. You don't have to identify anything. After that, all the way up until the AGM, you have got a passive duty. Meaning you don't have to identify things, but if someone tells you about something, they identify it for you, you can't ignore it. So number one is completely correct. So the answer is A or C. Where a material adjusting subsequent event is identified after the financial statements are issued, so they've been sent to the shareholders, meaning your audit report has also been finished, the auditor should include a qualified opinion in their audit report if management refuses to adjust the financial statements. The directors sign the accounts, we sign our audit report. The financial statements are then sent to the shareholders in advance of the AGM. If this mistake has been found, let's see what it says. After they've been issued but prior to approval, that means the mistake has been found there. And you cannot mention that in your audit report because you signed your audit report way back there. It is too late. You'd love to mention it, but it's too late. So the second one cannot happen. The answer is A. 3 more to do. Which of the following statements relating to internal and external auditors is correct? Did I just miss one out? Yes, I did. Let's do number 10 first. A significant change in the ownership of an existing audit client is a factor which makes it appropriate for the auditor to review the terms of engagement. Now let's be realistic. On every exam, you're going to see at least one thing, hopefully fairly small, which is going to make you think, I have never seen that before in my life. This is an incredibly minor point. If you see it, look at the number of marks, it's worth 1. So relax. You've got a 50-50 chance. Go with common sense. Does it sound sensible? Well, if the ownership of the client that you are auditing has changed, that could change your assessment of the integrity of the client, because maybe the new owner looks like a crook. And that might mean you don't want an engagement letter at all. This might make you want to resign. So yes, definitely. The answer is true. If the ownership of any organisation you deal with changes, I would imagine you might want to think about changing terms and conditions or even resigning. So if you do get something odd come up, try and relax and go with common sense. I don't see how anybody could go for B in a question like that. Number 11, almost there. Right, which of these following statements is correct? A, internal auditors are required to be members of a professional body. No, they are not. External auditors are. Internal, no rules. Internal auditors' scope of work should be determined by those charged with governance. Well, they are known as the Audit Committee, and earlier on this evening we said that is exactly one of the things that the Audit Committee should do. B is correct, so all we need to do is understand why C and D are not correct. External auditors report to those charged with governance. No, they report to the shareholders. We discuss our report with those charged with governance, the Audit Committee, before we send it to the shareholders, but we are required to report to shareholders. Internal auditors can never be independent of the company. But surely, if you outsource internal audit, they're just as independent as the external auditors. So the answer is B. And finally, this is a very good example of exam technique. Because this question is a little bit odd, and there were discussions with the examiner after we saw the exam paper to help clarify what she was getting at with one of the 4 points numbered 1, 2, 3, 4. Which two of the following controls of a sales system ensure that all goods dispatched, so if goods have left the building, are completely and accurately invoiced? Just think that through. We need a control to make sure that if goods leave the building, that creates an invoice. And the invoice is right. Number 1, goods dispatch notes are matched to sales invoices. Well, goods dispatch notes tell you what has left the building. So if we match those to each sales invoice, that would flag up if there are any goods dispatch notes we can't match to an invoice. So that's right then, isn't it? So we're down to a 50-50. Sales invoices are sequentially numbered. Well, that's good in that it means if you lose an invoice, you can see the gap in the numbering system. But if I've got 5 invoices numbered 1, 2, 3, 4, 5, that doesn't tell me that any of those things have been dispatched. We might have invoiced things that haven't been dispatched. And we might have dispatches where an invoice hasn't been created yet. So sequential numbering of invoices doesn't help make sure that you've invoiced for every dispatch. Number 2, does not achieve the objective we are trying to achieve. So the answer is D. Definitely. I'll look at the other 2 just for safety. Sales invoices are matched to customer orders. Well, that helps prove that you are invoicing at the right prices, but it doesn't tell you that those goods have actually been received by the customer, that they've been sent. There's no link to dispatches, so it can't be number 3. Number 4, has got to be correct. Let's see if we understand why. Now, this is the one that caused some debate. Regular review of unfulfilled orders. What is an unfulfilled order? Now, you might say an unfulfilled order is where a customer has ordered goods and we have not sent all of them yet to the customer. But that is where you are making a mistake, because you are looking at it from the customer's perspective. We need to look at this from the company's perspective. An order is only fulfilled from my perspective as a company if the goods my customer has ordered have been sent to them and we have invoiced them. And preferably they've now paid, then fulfilled. So the key here is to look at it from the company's perspective. And if we review unfulfilled orders, and I've defined an unfulfilled order as an order's been received, some goods may have been sent or possibly none, and we've invoiced for that, then we're going to flag up some items where the order was received, goods have been sent, but the invoicing hasn't happened yet, meaning we have not fulfilled and finished the order. And that is why D is correct. And yes, I think that's a bit weird as well. I got the right answer on number 12 on the basis that 1 is definitely right, 2 and 3 are definitely wrong. 4 looked a little bit weird, but because it was weird, I didn't think it was wrong. I just couldn't see why it was right at first. So, exam technique with MCQs, if you can narrow the answers down, it can certainly help you out. Right, enough. We have got to the end of revision. We have covered loads of audit standards and other little bits of knowledge by doing MCQs and by breaking up the long questions with looks at individual audit standards as we've gone. But we have spent a lot of time focusing very heavily on audit risk response, internal controls, objectives, procedures, tests, and substantive tests. Those are your big 3. And in the final week before the real exam, you must invest some time practicing as many long questions on those as you can. We have our mentoring session at the end of the week. Anything I pick up from the mock exam in terms of repetitive faults from students, I'll cover during that mentoring session. But for now, that is the end of the 4th revision session. Thank you for your sensible questions and your participation. But for now, it is time for me to say goodnight. And I'll see you on Friday for 1 hour of final preparation. See you then.